This coffee, seemingly ordinary. This house, a place of rest. This hospital bed in a quiet corridor. 3 completely different things, and yet, somewhere in the paperwork behind each one, the same 3 names keep appearing. This is not a secret cabal, not a hidden trust in a tax haven. 3 ordinary-sounding companies, BlackRock, Vanguard, State Street. Chances are part of your own retirement account already belongs to this story. Combined, these 3 firms now manage more than $25 trillion. That's larger than the GDP of every country on Earth except one, and that money doesn't sit still. It owns pieces of nearly everything. They are right now the single largest shareholder in roughly 88% of the S&P 500. Not owners in the way you own your car, something stranger and more complicated. So who really owns the modern economy? And what does own even mean here? Over the next 4 parts, we're going to trace the real architecture. No shell company myths, just the actual machine, which is stranger than the myth. The story starts in 1973, not in a smoke-filled room, but at State Street. That's where the first index fund was born. A boring idea that would eventually reshape who owns the world's companies. The idea was simple. Instead of picking winning stocks, just buy all of them. Lower fees, broader exposure, it worked. Millions of ordinary savers piled in, and so did their money, all pooled together. By 2007, index funds held about $2 trillion. By last year, more than $11 trillion. Every dollar funneled into just a handful of firms built to hold it all. Here's the part most people never learn. When you buy an index fund, you don't vote your own shares. The fund manager does it all, on your behalf, at every single company it touches. Multiply that by tens of millions of investors across thousands of companies, and 3 firms end up casting more shareholder votes than anyone else alive. Not because they schemed for it, because the system was built that way. Take a single company, Pfizer. The big 3 together are its largest combined shareholder block. That doesn't mean they run it day to day, but it means their votes carry real weight. The same pattern repeats across food, tech, energy, banking. Different industries, different products. Same 3 names near the top of the ownership list. That's not a conspiracy, that's what index investing does at scale. And it's exactly why regulators and lawmakers are starting to ask hard questions. Not is this illegal? Nobody has proven that. But is this healthy? When 3 firms sit atop nearly every boardroom in America. In 2024, a group of state attorneys general sued the big 3 directly. Their claim? Coordinated influence over energy company boards. The firms deny any wrongdoing in the ongoing case. The case is still working through the courts, so this isn't a hidden empire built from secrecy. It's something almost more unsettling. It happened in plain sight, one index fund at a time. Next, how the machine actually works and where the real debate begins. To understand how 3 firms ended up here, you have to understand indexing itself. It's not stock picking. It's not speculation. It's something closer to plumbing, and plumbing scales in ways people rarely notice. Every paycheck deduction, every automatic 401k contribution becomes one drop. Millions of drops flow into the same few reservoirs. Reservoirs run by BlackRock, Vanguard, and State Street. Reservoirs run by BlackRock, Vanguard, and State Street. BlackRock built something called Aladdin, a risk management system. It doesn't just track BlackRock's own money. Banks, pension funds, and governments around the world plug their portfolios into it too. By some estimates, Aladdin now oversees the risk on more than $20 trillion in assets, a meaningful slice of the entire global financial system. Runs partly through one company's software. That's not ownership, but it is a kind of visibility no government agency has. This is where the real cliffhanger of this story lives. Not a name that shouldn't exist, but a question. Regulators openly admit they haven't answered. What happens when a private company's software becomes financial infrastructure? Economists have a term for the concern: common ownership. When the same few shareholders own the top firms in an entire industry, does competition between those firms quietly soften, even without any direct agreement or anyone colluding? Researchers studying the airline industry found a pattern worth noting. Where common ownership was highest, some studies found ticket prices ran a bit higher too. Other economists dispute the size of that effect. The debate is very much alive. This isn't fringe theory. It's published, peer-reviewed, and still contested. Some economists say the effect is real but small. Others say the data doesn't hold up. Once you control for other factors, and the big 3 know the scrutiny is intensifying, in recent years, all 3 have expanded pass-through voting, letting individual fund investors vote their own slice of shares directly if they choose to. It's a real concession to a real pressure campaign. Whether it meaningfully dilutes their influence or is mostly symbolic is still being tested. Either way, the story is moving, not settled. So far, we've stayed with the boring, verifiable version of this story. No secret trusts. No entity that owns nothing. Just scale, enormous, well-documented, legally ordinary scale. Just scale, enormous, well-documented, legally ordinary scale. Here's the part the shadow empire framing usually leaves out. Most of that $25 trillion isn't the big three's money. It's yours. It's your neighbors. It's pension funds for teachers, firefighters, and retirees. The big three don't personally pocket the growth in your portfolio. They charge a small management fee, often a fraction of a percent, back, and the actual gains flow back to the millions of people whose money it started as. This is the tension at the heart of the real story. The same low fees that make index funds a genuine win for ordinary savers are the exact mechanism that concentrates voting power into just a few hands. No villain designed this outcome on a whiteboard. It emerged slowly from millions of individually reasonable decisions. To save more, pay lower fees, and trust the market instead of picking stocks yourself. So the real question isn't who secretly owns everything. It's when unintentional concentration reaches this scale, who's watching it and how. That question follows us into part 2. We've established the scale, 25 trillion, growing. We've established the mechanism, index funds, proxy votes, one dominant software platform. Next, we go inside the actual machinery of that influence. Part 2 goes deeper into that system, how passive investing actually functions, what economists on both sides of the common ownership debate actually argue, and why some lawmakers are finally trying to draw new lines around it. Because the honest version of this story isn't less dramatic than the myth. It's a live, unresolved argument about competition, retirement savings, and corporate power. And it's happening in courtrooms and Congress right now. 3 names, $25 trillion, 88% of the S&P 500. That much is fact, not myth. What it means for the rest of us, that's where the real investigation begins. Every time you set up automatic retirement contributions, you make a choice. Usually, that choice defaults to a broad index fund. Cheap, diversified, historically reliable. You rarely see what happens to the voting rights attached to those shares. By default, the fund manager votes those shares for you. Multiply that across tens of millions of accounts and thousands of underlying companies. That's the entire mechanism. No hidden meetings required. In 2008, the Big Three's combined ownership of the S&P 500 sat around 13.5%. By last year, that figure had climbed past 22%. Some economists warn that if the trend continues, 30% could arrive within a decade. John Bogle, the founder of Vanguard himself, once called this exact threshold a serious concern. The man who invented the index fund warned about the scale it might someday reach. That warning came from inside the industry, not from outside critics. In late 2024, 11 state attorneys general filed suit against BlackRock, Vanguard, and State Street. Their claim: coordinated pressure on coal company boards through shared ownership and shared goals. It's one of the most serious legal tests common ownership theory has ever faced. The lawsuit alleges the firms pushed for reduced coal production to advance climate goals, using their combined voting weight to steer several major energy companies. The firms have filed to dismiss the case, calling the claims baseless. It's worth being precise here. No court has ruled the firms guilty of anything. The case is still in its early stages, and legal experts are split on whether it will succeed. This is genuinely unresolved, not a settled scandal, and not a cleared name either. And here's a detail that complicates the activist empire narrative. Support for environmental and social shareholder proposals from these firms actually fell in recent years, from roughly a fifth of votes down to single digits at some of the three. Which points to the real story. These firms are being pulled in opposite directions at once. Sued by some states for being too aggressive on climate, criticized by others for retreating from it, both pressures at the same time. This is what real concentrated power actually looks like in practice. Not a single coordinated agenda, but a company big enough to be blamed for every agenda at once. That itself is worth examining closely. Now, the part of this story that genuinely deserves more scrutiny, Aladdin. BlackRock's risk management platform doesn't just serve BlackRock's own funds. Pension systems, insurers, and even some central banks license it to monitor their own risk. By some public estimates, the system tracks risk on well over $20 trillion of assets globally. That's not the same as owning those assets. But it does mean one company's software has an unusually wide view into the world's financial plumbing. Regulators have openly debated whether firms like this should be labeled systemically important, a designation usually reserved for banks too large to fail. So far, none of the big three carry that label. Whether they should is an open policy question. Meanwhile, for the ordinary investor, none of this changes the basic math. Index funds still cost a fraction of what actively managed funds charge, and low-cost investing has demonstrably helped millions of people retire with more, not less. That's the trade-off nobody's shadow empire narrative wants to sit with. The same mechanism that concentrates voting power also lowered the cost of retirement for millions. Both things are true. Neither cancels the other out. Antitrust regulators are watching closely but cautiously. Breaking up index funds would undo the exact cost savings that made them popular in the first place. That's the real policy puzzle. Not villainy, but genuine trade-offs without an easy fix. Some proposed reforms focus on transparency, forcing clearer disclosure of how funds vote. Others focus on choice, expanding pass-through voting so individual investors decide for themselves. None of these proposals have become binding law yet. Right now, if you want more control, you can actually ask. All three firms now offer some version of pass-through voting to institutional and individual clients. Adoption is still low. Most people don't know the option exists. So the actual power you have here isn't mythical, it's mundane. Read your fund's proxy voting policy. Ask whether pass-through voting is available. It won't dismantle $25 trillion, but it's a real lever, and it's yours. We've covered the mechanism, the lawsuits, and the genuine trade-offs. There's one more myth we need to correct directly, and it involves the house you live in. Because the popular version of that story and the actual data tell two very different tales. You've likely heard the claim, Wall Street is buying up all the houses. That giant funds now own your neighborhood, pricing out ordinary families forever. It's one of the most widely repeated economic claims of the decade, so let's actually check it. Government researchers and multiple independent analysts have actually measured this, and the real number is far smaller than the viral claim suggests. Nationally, large institutional investors own roughly 1 to 3% of single-family homes. The U.S. Government Accountability Office studied this directly across 6 major metro areas. Even in hot markets, institutional ownership topped out around 22% of rentals, and far less of total homes, most of which remain owned by small local landlords. Multiple independent studies, from Brookings to the Urban Institute, land on similar figures. The overwhelming majority of rental single-family homes are owned by everyday landlords, not investment firms with briefcases of institutional cash. That said, the story isn't uniformly reassuring everywhere. In specific fast-growing Sunbelt metros, think Atlanta, Phoenix, Jacksonville, the concentration is real. Regional impact and national impact are two very different measurements, and both matter. And even nationally, this part is true. At their 2022 peak, investors of all sizes bought over a quarter of homes sold. That figure includes small local investors, not just institutions. But it did mean real families in real markets competing against cash buyers. Which brings the story fully up to date. Just weeks ago, Congress passed new housing legislation, restricting large institutional investors from certain single-family home purchases. It passed with overwhelming bipartisan support, a rare thing in this political era. Even the firms most associated with this narrative say their institutional home purchases are already down more than 90% since 2022, retreating, not expanding. The empire this story imagines is, by its own numbers, shrinking in this specific market. So the honest version isn't, you'll never own a home because a shadow empire owns it all. It's more specific and frankly more useful. Watch your local market, not a national myth. Institutional buying is a real regional risk, not a nationwide takeover. Two very different corners of this story, both real. $25 trillion concentrated in 3 companies' hands through public market shares. And a housing market shaped far more by mortgage rates and supply than by institutional buyers. There's one more layer to this story, and it's less about ownership, more about speed. Algorithms now execute a majority of daily stock trades in milliseconds. That shift changes who has an edge, and it's the subject of Part 4. Even in housing, automation shows up not as a shadow empire, but as instant cash offer apps. These tools let some buyers move faster than a traditional mortgage ever could. Whether that's convenience or unfair advantage depends entirely on who you ask. Part 4 goes there directly, what predictive algorithms can and can't actually do, in markets, in housing, and in the broader ownership economy debate. And we'll end with the honest question this story deserves, not a manufactured one. We've now separated fact from myth on ownership, on votes, and on housing. None of it required an invented villain. The real story was compelling enough on its own. One more layer remains. What happens when the algorithms start making the decisions? $25 trillion. 2 lawsuits still undecided. A housing myth we just corrected with real data. This is what concentrated capital actually looks like, bigger and blurrier than any conspiracy. Next, the algorithms deciding what happens with all of it. Ownership was part 1 and 2. Speed is part 3. Today, a majority of stock trades aren't placed by a person clicking buy. They're placed by algorithms, competing to react microseconds faster than each other. Firms have spent hundreds of millions of dollars shaving milliseconds off cable routes. That's not science fiction. It's a well-documented, decades-long arms race. It's also why we've seen real flash crashes, sudden automated sell-offs lasting minutes. The most famous, in 2010, briefly erased almost $1 trillion before markets recovered. Regulators added new circuit breakers afterward. The same logic reached real estate through so-called iBuying, instant algorithmic home offers. Companies tried automating home valuation and purchase at scale earlier this decade. Several major programs actually shut down after losing money. The algorithms mispriced homes badly enough to cause real financial losses. Automated home buying didn't quietly conquer the market. It stumbled publicly and pulled back. That's a meaningfully different ending than the viral version tells. That doesn't mean predictive analytics vanished from real estate. Far from it. Smaller, more targeted algorithmic buying still exists for rental portfolios. But AI outbidding every human buyer overstates the actual data. Where automated trading really does dominate is public equity markets. Stocks, not houses. Index funds themselves rely on automated rebalancing to track their benchmarks precisely. It's mechanical, but it means fewer humans touching each trade. Every quarter, index funds automatically buy and sell to match their target benchmarks. When a company gets added to or dropped from an index, billions can move within days. That's real market power, happening by formula, not discretion. Studies have documented what's sometimes called the index effect. Stocks often jump in price simply from being added to a major index. It's one of the clearest examples of index fund influence on the real economy. Economists still debate how large and lasting that effect really is. Some studies find it's shrinking as more capital chases the same predictable pattern. Others argue it remains a meaningful, if narrowing, market distortion. Beyond stocks and homes, there's a broader shift: the subscription economy. Software, entertainment, even car features now rent access instead of selling ownership. That's a real trend, not evidence of a single coordinated empire. Some automakers piloted subscription pricing for features like heated seats. Public backlash was swift, and companies rolled the pricing back. Consumers pushing back successfully is also part of this story. Different industries adopt subscription models for different reasons: recurring revenue, easier updates, lower upfront cost. Again, real trend, genuine trade-offs, no single empire directing it from one boardroom. Housing has seen a modest shift toward renting, driven mostly by affordability and mortgage rates, not algorithms. The economic pressure on young buyers is real. Its cause is more mundane than a shadow empire. Mortgage rates, construction costs, zoning, and wage growth. These are the well-documented, boring drivers of housing affordability. None of them require a villain. All of them are harder to fix than blaming 3 companies. So here's where the honest version of the shadow empire actually lands: 3 enormous asset managers, real concentrated voting power, and open policy debates. A housing market shaped by rates and supply, not secret ownership. And a subscription economy that's real, contested, and pushing in both directions at once. None of it needed inventing. The true story was already this complicated. That's usually the sign you're looking at something real. We have one part left, and it's the part that actually matters most. Not who owns everything, but what should any of us actually do with this information? That's where we're headed in the final part of this story. Because unlike a shadow empire, this system actually responds to scrutiny. Lawsuits move it. Legislation moves it. Even individual investors asking questions move it. That's a very different story than one where nothing matters. Regulatory comment periods, congressional testimony, ongoing lawsuits, these are public processes. Anyone can read the filings. That transparency is the opposite of a hidden empire, even when the scale feels overwhelming. In fact, you can check a company's largest shareholders yourself for free right now. The SEC publishes 13 F filings quarterly, a public record of institutional holdings. No shadowy access required, just a willingness to read a website. Search any public company's name plus 13F, and you'll see its largest institutional shareholders. More often than not, you'll spot the same 3 names near the top. Now you'll know exactly why, and what that ownership does and doesn't mean. This isn't a call to panic or to pull your retirement savings out of index funds. The data doesn't support that. It's a call to understand the system you're already part of more clearly than before. And it's a reminder that the "you'll own nothing" narrative, taken too literally, ignores the data. Most Americans who buy homes still buy them from other families. The struggle is real. Its cause is rates and supply, not a hidden empire. The more productive fight, based on the actual evidence, is over zoning reform and housing supply. That's less dramatic than a shadow empire. It's also the fight more likely to actually lower prices. Boring advocacy beats viral outrage. We already saw this play out this year, with bipartisan housing legislation actually passing. That happened because of real data on institutional buying, not viral claims. Accurate information is what actually moves policy. The viral version of this story usually gets the scale roughly right and the mechanism almost entirely wrong. Real concentration exists in public company shares, not in secret ownership of your street. That distinction matters. Misdiagnosing the problem leads to the wrong solution. If you think it's a secret empire, you look for a villain. If you understand the mechanism, you push for the specific reforms that would help. Both live lawsuits against the big three are still working through the courts. Their outcomes could genuinely reshape how index funds vote in corporate elections. This is a story that will keep changing, worth watching, not worth mythologizing. So if you take one thing from this story, let it be this: concentrated financial power is real, documented, and worth watching closely. But watching closely means checking the data, not repeating whatever feels most alarming. You don't live in a secret portfolio owned by nameless shells. You live in an economy where 3 companies manage an enormous share of public markets, a fact you can verify yourself in about 5 minutes on a government website. That's a more useful ending than a haunting rhetorical question for comments. The source numbers are unsettling enough. They don't need embellishment. And this system is still subject to lawsuits, laws, and daylight. If this changed how you think about your retirement account, that's the point. Not fear, not outrage, just a clearer picture of a complex system. That clarity is worth more than any viral cliffhanger. 3 companies, $25 trillion, 2 unresolved lawsuits, 1 corrected housing myth. That's the real shadow empire. Verifiable, imperfect, and still being argued over. The truth was already big enough. The real story was never hidden. It was just waiting for someone to actually look. We've covered who owns the shares and how algorithms move the trades. But underneath all of it sits something almost nobody outside finance has ever heard of. A single piece of software so large that a meaningful share of the world's tracked money runs through it every single day. Its name is Aladdin, and its origin story starts, of all places, with a very expensive mistake made decades ago. By the end of this part, you'll understand why regulators keep circling back to it, and why they still haven't decided what to do. In 1986, a young bond trader named Larry Fink ran a mortgage securities team at the investment bank First Boston. A single mispriced bet on where interest rates were headed cost the firm roughly $90 million in a matter of months. Fink has said publicly in multiple interviews over the years that the experience reshaped how he thought about risk for the rest of his career. The lesson wasn't, don't take risks. It was that risk itself needed to be measured and modeled systematically, not estimated by gut feeling. That single painful lesson from a trading floor 4 decades ago is the reason this entire story exists. 2 years after that loss, Fink and a small group of co-founders built a system designed to do exactly what the industry lacked. They called it Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network, a clunky acronym for an ambitious idea. It ran at first on a single Sun Microsystems workstation tucked into a small office with only a handful of employees. There was no grand plan to build the financial system's plumbing. There was just a small team trying to avoid repeating one bad trade. Nobody in that room, by all accounts, expected it to become what it is today. By 2013, according to reporting at the time, Aladdin was tracking about $11 trillion in assets worldwide. That figure represented roughly 7% of the entire planet's financial assets, moving through one company's technology. By 2020, public disclosures put that number at $21.6 trillion, nearly double in under a decade. And as of the most recent figures reported in late 2025, estimates place it close to $25 trillion, running across roughly 6,000 computers that simulate thousands of possible futures for every single portfolio it touches. Here's what the system actually does, stripped of jargon. It runs Monte Carlo simulations, thousands of randomly generated future scenarios, to estimate how a given portfolio might behave in a downturn, an interest rate spike, or a full-blown financial crisis before any of it happens. That's not exotic or secretive technology. It's the same statistical method physicists, actuaries, and epidemiologists have used for generations. The innovation was never the math. It was building software big enough for the whole industry to eventually depend on it. And here's the detail that separates Aladdin from an ordinary piece of corporate software. It isn't just BlackRock's internal tool anymore. Public reporting indicates that over 1,000 separate organizations now license Aladdin to help manage their own money and risk exposure. That client list reportedly includes pension systems, insurers, sovereign wealth funds, and some of BlackRock's own direct competitors in asset management. In other words, rival firms that compete fiercely for the same investors' dollars may still be running their risk math on the same shared platform. According to industry coverage, some of the largest technology companies on Earth, Apple, Microsoft, Google among them, have used Aladdin's tools to help manage portions of their own corporate treasury and investment operations, which means, in practice, even the companies building the cloud infrastructure are users. It's a strange kind of loop. The technology giants who host the platform and the technology giants who use it are, at points, the very same firms. That overlap is exactly the sort of interconnection that makes financial regulators uneasy, even when nothing improper is happening at all. In 2022, BlackRock announced its first major cloud partnership, moving Aladdin onto Microsoft's Azure platform. Then, in December of 2025, it added a second, bringing Aladdin to Amazon Web Services as well, a genuine multi-cloud expansion, which means the same company providing cloud servers to Aladdin is also simultaneously one of the platform's clients managing its own money on it. General availability for enterprise clients hosted in the United States is expected sometime in the second half of this year. Within months, one company's software will run across the world's largest clouds. It will be serving commercial banks, insurance companies, national governments, and technology giants, sometimes on genuinely shared infrastructure. No single one of those relationships is unusual on its own. Financial firms rent cloud space from Amazon and Microsoft constantly. It's the sheer density of overlapping relationships, all routed through one platform, that makes this genuinely unlike anything that came before it. This isn't a side project quietly running in the background of BlackRock's business. It's a fast-growing revenue line in its own right. The company's technology services and subscription revenue grew 24% year over year in 2025. Annual contract value climbed 31%, approaching $2 billion heading into this year. And that's software licensing revenue. BlackRock increasingly makes money two separate ways: managing trillions directly and selling the tools that let other firms manage their own money too. Selling the picks and shovels turned out to be almost as valuable as running the mine itself. But this raises the exact question regulators have circled for a decade. If one piece of software helps manage this much of the world's tracked money, what happens if that system fails, even briefly? Or, more subtly, what happens if it quietly nudges thousands of technically independent portfolios to behave the same way at the same moment? That second question turns out to be the one that has actually kept regulators awake, more than the fear of a simple outage. It's the difference between one company's server crashing and thousands of companies flinching in unison because they all trust the same warning light. This particular concern didn't begin with Aladdin at all. It began after the 2008 financial crisis nearly took down the global economy. In its aftermath, Congress passed the Dodd-Frank Act and created an entirely new regulatory body, the Financial Stability Oversight Council. Its explicit mandate was to identify companies, even ones that aren't traditional banks, whose failure could threaten the stability of the entire financial system. The council was Washington's attempt to make sure that particular blind spot never happened again. In 2013, they used that new authority for the very first time. They formally designated 4 companies as systemically important: AIG, GE Capital, Prudential Financial, and MetLife. Each designation triggered a new layer of oversight from the Federal Reserve, the kind usually reserved for the country's largest banking institutions. It was, at the time, a genuinely unprecedented use of federal power over companies that had never answered to a bank regulator before. And it set the template that everyone in the asset management industry would watch nervously for the next several years. The designated companies did not accept this quietly. MetLife sued the federal government directly, and in 2016, a court sided with them, overturning the designation entirely. General Electric sold off its entire financial services division, specifically to shed the risk of being labeled systemically important. By 2018, every single one of those 4 original 2013 designations had been formally reversed, rescinded, or made moot through corporate restructuring. The council's very first attempt to use its new power ended 4 years later with essentially nothing left standing, but regulators were already looking at what's next. Whether that particular risk is large enough or specific enough to justify a formal systemic designation remains a genuinely open and actively contested question among economists and regulators alike. Industry analysts as early as 2013 predicted that asset managers, specifically BlackRock and Vanguard, would be the council's next likely target. It has been sitting inside mainstream financial regulation unresolved for well over a decade at this point. At the time, a BlackRock spokesperson addressed the speculation directly and publicly. The company said regulators hadn't even specified what a designation would require. BlackRock said it was watching the situation closely and working with policymakers to clarify how its risk profile differed from a bank's. Even the firm at the center of this debate has, on the record, called the process genuinely uncertain and unresolved. It wasn't a denial that scale mattered. It was an argument about what kind of oversight actually made sense for that scale. In 2019, the council formally rewrote its rulebook. It shifted away from designating individual companies toward analyzing risky financial activities instead. Asset managers welcomed the change, as it meant no single firm would likely be singled out under the new framework. Critics called it a deliberate retreat from real oversight. Supporters called it a more accurate way to measure genuine financial stability risk. The pendulum swung back again in 2023 when the council restored its broader authority to designate individual firms once more. The new framework explicitly listed asset managers and private investment funds as categories of risk it would formally monitor. Advocacy groups publicly urged regulators to use that restored authority against firms over their fossil fuel financing exposure. No such designation has followed yet, but the legal authority to pursue one is now, once again, explicitly back on the table. No such designation has followed yet, but the legal authority to pursue one is now, once again, explicitly back on the table. Their argument was about scale, interconnection, and unmanaged climate exposure. If a few firms manage assets at this scale, shocks could ripple through the economy. Advocacy groups publicly urged regulators to use that restored authority against firms over their fossil fuel financing exposure. Industry defenders counter that diversified index funds spread risk across entire sectors rather than concentrating it. Neither side has produced evidence that has settled this argument definitively in either direction as of today. This is not some settled historical debate. It is still actively moving right now this year. In December, an SEC commissioner questioned the council's approach again. In December of last year, a sitting SEC commissioner publicly questioned the council's overall approach to non-bank designations yet again in an official statement. The statement argued that designation brings a new regulator, the Federal Reserve, that may lack the specific industry expertise. Whether that argument gains traction or is itself reversed by a future administration is genuinely impossible to predict from where this story stands today. Here's the technical worry that keeps resurfacing: what experts call model monoculture. If everyone runs the same risk math, they all react the same way. If thousands of technically independent competing funds all run their risk calculations through the exact same underlying software and the same historical assumptions, they may end up interpreting the same warning signals the same way. In a genuine crisis, though, critics worry that same shared logic could turn thousands of individually reasonable decisions into one enormous synchronized market move. A former chief executive at a rival investment firm put this concern bluntly in on-the-record comments to industry press coverage. BlackRock has pushed back, arguing the tools are designed to support human judgment, never to replace it. Both positions can be true at once. No regulator has yet produced hard evidence proving this specific monoculture risk has actually caused a crisis. It remains, for now, a documented theoretical concern rather than a proven cause. It's also worth stating plainly that Aladdin does not operate entirely without competition in this market, but their existence matters for the story. This is a competitive market with real alternatives, not a single company operating entirely unchallenged. Denmark-based SimCorp, along with smaller providers, compete for the same institutional clients. None currently approach Aladdin's scale. Each acquisition, taken alone, is a fairly ordinary piece of corporate strategy. Companies buy smaller firms to add capabilities constantly across every industry. State Street, one of the other members of the so-called Big Three, built a rival platform called Charles River, aiming to offer a similarly comprehensive investment workflow. Taken together, over a decade, they represent a steady, well-documented expansion of one platform's reach into corners of the financial system that are inherently harder to see into. More recently, it acquired Precon, extending Aladdin's visibility deep into an asset class regulators have historically watched far less closely. Each acquisition taken alone is a fairly ordinary piece of corporate strategy. Companies buy smaller firms to add capabilities constantly across every industry. In 2019, it acquired eFront, a private market software provider, folding its tools directly into Aladdin to cover private investments alongside public ones. Unlike public stock markets, these assets aren't priced daily on an open exchange, aren't required to disclose nearly as much information, and are genuinely harder for outside regulators to independently verify. Unlike public stock markets, these assets aren't priced daily and aren't required to disclose nearly as much information. A single platform with visibility into both public and private markets simultaneously occupies a vantage point that no single entity has held before. That's not necessarily evidence of misconduct. Much of this data sharing happens because clients specifically request an integrated view across their entire portfolio, public and private together. But it does mean the parts of the financial system that are hardest to monitor from the outside are increasingly visible from exactly one vantage point on the inside. There's one more risk category regulators have explicitly flagged: cybersecurity. A sustained attack on infrastructure this concentrated would be catastrophic. There's one more risk category regulators have now explicitly and formally flagged in writing: cybersecurity. The Council's 2023 Systemic Risk Framework named cyber incidents as a factor it would formally track. This isn't speculative alarmism. It's the explicit, published reasoning behind why cybersecurity now sits alongside bank capital ratios as a formally monitored category of systemic risk. There's one more risk category regulators have now explicitly and formally flagged in writing: cybersecurity. The Council's 2023 Systemic Risk Framework named cyber incidents as a factor it would formally track. Splitting infrastructure across independent providers reduces the odds that one outage or attack takes the entire system offline. Advocacy groups publicly urged regulators to use that restored authority against firms over their fossil fuel financing exposure. In 2019, it acquired eFront, a private market software provider, folding its tools directly into Aladdin to cover private investments alongside public ones. Whether that architecture is sufficient protection against a truly systemic, coordinated event is a matter of genuine expert disagreement. That overlapping dependency is a structural feature of modern finance, the result of institutions choosing to buy proven infrastructure. It's the natural result of large institutions all rationally choosing to buy proven, tested infrastructure, rather than build fragile, expensive systems entirely from scratch on their own. Regulators are still developing the analytical tools needed to properly measure exactly how much systemic risk this kind of shared dependency actually creates in practice. Its most recent disclosures point to sustained double-digit growth targets, blending traditional fees with technology licensing revenue. The regulatory questions and the company's growth story are effectively running on two separate tracks inside the very same building. The regulatory questions covered in this part and the company's own confident growth story are effectively running on two entirely separate tracks, inside the very same building at the very same time. Whether those two tracks eventually collide in the form of new binding regulation remains one of the genuinely open questions this documentary leaves unanswered. Skeptics counter that regulating a specific piece of technology could prove clumsy, expensive, and ultimately miss the real target entirely. Neither side has definitively won this argument, and nothing in the current record suggests that's likely to change imminently. That's the honest shape of this fourth and final part. Not a hidden system secrets, but a real piece of infrastructure regulators are actively deciding how to watch. Neither side of this debate has won yet, and it's likely to keep resurfacing every time global markets go through a genuine period of volatility. And it's exactly the kind of story that rarely goes viral, because there's no single villain to point at, just a system still learning how to watch itself. This is, in a very real sense, genuinely new territory for financial regulation, not an old problem simply repeating itself under a new name. Neither side of this debate has won yet, and it's likely to keep resurfacing every time global markets go through a genuine period of volatility. The regulatory rulebook is still visibly catching up to a scale and kind of concentration that nobody fully anticipated when original laws were written. Older financial laws were written primarily to police traditional banks and insurance companies, not the software vendors quietly underneath them. That gap between the pace of technology and regulation is one of the more honest through lines across this entire four-part investigation. The Council publishes a detailed annual report to Congress, freely available online, laying out exactly which risks it is currently monitoring. No leaked internal documents are required, no whistleblowers, just a willingness to read a government report that most people never open. The same goes for BlackRock's quarterly earnings disclosures, which are legally required public filings, freely searchable through the Securities and Exchange Commission's own website. Everything cited across this entire investigation came from these kinds of public, verifiable sources. Nothing hidden, nothing requiring special access. Everything cited across this entire investigation came from these kinds of public, verifiable sources. Nothing hidden, nothing requiring special access. So here, finally, is the full and honest shape of this entire investigation, assembled from four separate but connected threads. So here, finally, is the full and honest shape of this entire investigation, assembled from four separate but connected threads. A widely repeated housing myth turned out to be considerably smaller in reality than the viral headlines ever suggested. And one piece of software quietly became the operating system underneath a meaningful share of the world's tracked money. None of this required a hidden empire or a name that shouldn't exist, buried 7 layers deep. It required 3 companies and 1 platform. That argument is happening right now in published reports and open hearings that anyone with an internet connection can read for free. If you want to verify any part of what you just watched, start with the FSOC's report and BlackRock's earnings filings. So here finally is the full and honest shape of this entire investigation, assembled from 4 separate but connected threads. If you want to verify any part of what you just watched, start with the FSOC's annual report, BlackRock's public earnings filings, and the SEC's own Edgar database.